Okay, everyone, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. Thank you very much for joining me. Let's go through CPI data. Quite important to see what the Federal Reserve will do at their next meeting, whether they decide to continue pausing rates or whether they are nudged in the direction of hiking instead. So first we have to understand what is CPI release, what is it all about? It is how much consumers are paying for retail goods and services, the percentage of that there, and 26,000 retail outlets, 4,000 housing units in 87 urban areas are measured for where prices are measured, collected, and prices are collected on 80,000 different goods and services. So very accurate read on what inflation is like in the urban areas, whereas the PC data measures the US as a whole. But of course, the urban areas is where most of the money is spent. So again, a very accurate gauge of what spending habits are like within the US and whether prices are rising or going up. So key measurements then that form the CPI report. So you have housing that represents about 42%, food and beverages about 14%, transportation about 18%, and medical care about 8.5%. And then of course you have the core read, which excludes food and energy. And then you have the seasonally adjusted or the month-to-month figure or read that is seen as a more preferred. Usually when the central bank isn't in a tightening or hiking phase, or and the economy is on a nice and easy path. So the month-to-month figure is usually preferred, but in this hiking cycle, or let's say if we're at the end of the cycle, near enough at the end of the hiking cycle, I've probably said that each time, quite a few times now when I've said we're near the end of the hiking cycle, but inevitably the Fed keep raising their expectations of where they see the federal funds target. But again, usually the month-to-month is preferred because it shows what's going on in the economy without the effects of weather, production cycles, etc. Then continue on then, so the difference between PC and CPI, I've already kind of mentioned it, that one's more of a looks at the whole of the US. But the other thing is about the PC price index compared to the CPI is that the PC inflation data places a lower weight on prices of gasoline and of residential unit rents and focuses on the nation as a whole rather than just focusing on urban areas. How does it affect the markets with the CPI data? Very simple. When the CPI is stronger than expected, usually it shows that the economy is growing and consumer spending habits are moving in a positive direction. However, in this current environment where the central bank is hawk-eyed and laser focused on getting inflation down to the 2% target, then what happens is the expectation for rate hikes increases, and so does the value of the dollar. Of course, the higher that your rate of interest is, the more attractive it is to international investors to jump into a currency that's going to give them a higher return. Of course, then for the stock market, usually, and when you do see usually or normal market environments where there is no tightening cycle that's going on, when you do see CPI prints that are higher than expected, then usually the stock market likes it because, again, it refers to more money is being spent on goods and services for the goods and services being provided, and businesses will, of course, get more money for that. But in this tightening cycle, it's the opposite. Higher than expected CPI data usually leads to stock markets taking a hit. So they're very, very sensitive to the inflation data, particularly the core data. Of course, you're excluding the volatile parts of the report, food and energy, to see what inflation is actually like in goods and services. So again, a sharp rise in core data usually leaves the stock market taking a hit. Then for the bond market, simple. whenever inflation goes higher in a tightening environment and the central bank is focused on bringing it down, the bond yields go higher in anticipation for higher rates, and bond prices head lower. So the rates are the bonds that are affected the most are the short-term bonds. So you're thinking about so if you're looking at the yield curve, the 3-month being the shortest is the one that's most affected. But for traders, the ones or the bond futures that they're able to trade for the 2-year bonds, that's the most sensitive. So usually, again, if you do get higher than expected inflation data, then bond prices head lower as bond yields start to rise. Then for the previous report, for what we had seen in June, looking at the May data, so the index for food and shelter, the index for shelter was the largest contributor to the monthly all items increase, followed by an increase in the index for used car and trucks. The all items index increased 4% for the 12 months ending May, which was the smallest increase since the period ending March 2021. So we've seen that quite a bit coming a couple of times now, where the data for the year on year has been the smallest since the prior period that it was measuring. But that is a positive sign for the Federal Reserve's job being done. But of course, it's a short-term reaction that traders are focused on, whether it slightly tops the expectation or goes below, or if it completely blows the data out of the water. Now, the economy at the moment, what are the effects on, or the potential effects on inflation? What's going to have an impact on inflation? So these are the different releases that everyone should be looking at, really, at least these releases, to understand what inflation pressures could be like in the US. So you had non-farm payrolls that had a solid report at 209K, although it was lower than the forecast when the data did come out. Smaller than the prior figure of 339K. Unemployment rate ticked lower as well to 3.6 from 3.7. Average earnings year on year still a concern, 4.4% compared to 4.3%. Employment cost at 1.2 compared to 1%. PCE price index at 3.8 compared to 4.3. Core PCE price index, again, the core data has always been the sticky part in both the CPI and PCE data, because of course, when you exclude food and energy, that's the key. Those are the key measures or metrics to be aware of, particularly for the Federal Reserve, to know that inflation is actually coming down as quickly or as quickly as the Federal Reserve would want it to come down. ISM manufacturing prices paid was at 41.8 compared to 44.2. The services was at 54.1 compared to 56.2. So you see there in the industrial, in the manufacturing side and the services side, price pressures are coming down slightly. Maybe not, again, on the services side, still quite strong compared to the ISM, the manufacturing side within the US. Productivity was slightly higher, minus 2.1 compared to minus 2.7%. Import prices was lower than the previous at minus 0.6. Exports were also lower as well, minus 1.9%. PPI year on year, which is also this week as well, year on year was at 1.1% compared to 2.3%. The core data was at 2.8% compared to 3.2%. So overall, you see that inflation in the US overall, the pressures of inflation are coming down. It's just the question is, has it come down far enough of what economists are expecting, or will the inflation print go down but be higher than the forecasted figures that we get? So that's the question. And that's what we're going to look at and cover as to what the market reaction was like the last time around, and what is the sentiment surrounding the US inflation print at the moment. Don't forget, if you've liked the video so far, help get the word out there, share it with your fellow traders and friends if you found the information useful or insightful. If you haven't, let me know in the chat, and we can work on that for future live streams. So then the triggers for the economic release. Now, sometimes in the past there have been triggers for the CPI data where there's been 0.2% deviation from economists' expectations. But considering the last report that we had, where it's very sensitive to the data, having more or less 0.1 deviation on either side of each of the economic releases is, what we're kind of looking at as our triggers. So for the month with a high estimate of spot 4% and a low of spot 2, year on year with a high of 3.2% and a low estimate of 3%, core month high with a of spot 4% and a low of spot 2%, and the core year on year with a high estimate of 5.1% and a low estimate of 4.9%. So again, we've just got to be aware that inflation data, the markets are still sensitive to it. Although we haven't seen in the past recently the big reactions that we've seen, if we're going back to, let's say, all the way to, July or last year, actually, where you had seen 1,400 ticks down on the Nasdaq and about 300 ticks down on the S&P. We're not at those levels now, or recently, what we've seen from the data, but the markets are still sensitive to it, and there is still a reaction from the release. So, sentiment of views then. So, Goldman Sachs CEO says that given what is going on in the world, it is difficult to see inflation returning to 2% anytime soon. July 7th from Goldman Sachs again as well, led by including Ferrario, said a note that equity bond correlations have turned more positive recently, making it too early to dismiss the risk of higher rates weighing on stocks. So what does that mean? Usually, when there is more risk that is involved, and there's more of a risk of sentiment that occurs or is present, let's say, traders are more inclined to put their money away into safe haven assets. Okay, and usually what happens is sometimes what happens is that people will put their money to park their money to bonds, where bond prices will start to go higher and the yields start to go lower as well. Now for the stock market, so one of the things you've got to be aware of as well, that if the expectation in this scenario, the scenario is that if the Fed is nearing their tightening cycle, nearing the end of their tightening cycle, now that the Federal Reserve doesn't have to do that much work, and so bond yields also go down for that reason too. They're not expecting that much more rate hiking from the Federal Reserve, and if the stock market starts to go up at the same time, again, Goldman Sachs is highlighting that it might be a bit too early to make a call to say things are now fine and dandy and the Federal Reserve is done with their job, basically. So that's what you've got to take away from that. July 11th, you had HSBC saying, although US equity markets have factored in a soft landing or a more accommodative recession, the real risk is that the downturn will be more severe than anticipated. So again, more or less like Goldman Sachs have said, that getting ahead of the market's trying to get ahead of itself is probably not a good idea. So what does that mean for ourselves today? Well, it could mean that if we do get inflation data that is lower than expected, that might not be enough for the Federal Reserve to say that they're done and that they're not going to hike 2 more times this year. Okay, it might mean that that they could do those 2 hikes still, even if inflation comes down a bit more today. So everything is out in the open yet. We've got to understand what the Federal Reserve might do in the future. We have to listen out for what the Fed members say, particularly the voting members, or whether they say, a pause, could be warranted again, and the likelihood of 2 additional rate hikes, or maybe even an additional rate hike, is not warranted as much as it was in the past. Okay, Fed and government views. Oh, for a second, I thought that was Mester. Fed's Mester, it says. in the chat there, kind of spooked me. I was about to talk about that. Fed and government. So Fed and government views. Fed's Mester says, I expect housing inflation to ease, but it's still an upside rise for price pressures. Bostic said that we may need to do more on rates if inflation expectations de-anchor or unanchor. Even with a 25 basis point hike in the next meeting, will still require patience from there, and that he's not expecting to see dramatic sea changes in inflation. Fed states inflation is printing too high and we need to keep raising rates. And then the market pricing, this is also quite important to understand as well, as to what are the markets seeing for rates after they've seen previous data come out, not just for CPI. We're talking about non-farm, also the Conference Board Consumer Confidence Index as well. There was a bit of a reaction from that too. Those important bits of data that traders have been reacting to, and in the money markets have been reacting to as well. So June 14th, you had post the FOMC SEP, where they saw the Fed funds rate at 5.6% at the end of the year compared to 5.1% previously seen. Fed swaps no longer consider 2023 rate cut likely. Hello, Petroliano. Good to see you too. Good to see you. Yes, so again, Fed swaps no longer consider 2023 rate cut as likely. Of course, in the past, we've had it where 100 basis points worth of cuts was expected by the Federal Reserve in the aftermath of the fallout from SVB and also Credit Suisse too, and the issues that the banking sector had, the global banking sector had at that time. At June 27th, post the Conference Board confidence data, when the data was higher than expected, swaps referencing Fed meetings were unchanged for July, with approximately 21 basis points of hike premium priced unchanged on the day after the data. So it didn't do too much to the expectations of what the Fed might do in the future, but again, it was quite key there. For the markets to take in. June 29th, Fed swaps see 50% chance of a second rate hike by the year end. And then June 30th, US short-term interest rate futures traders slightly trim bets on Fed rate hike after inflation and spending data. Of course, that's referring to the PC price index data. So again, this is what you have Goldman Sachs and HSBC talking about, that the markets, usually there's that initial jump that occurs in expectations when inflation is higher than expected, that the Fed might, go down one route, or may go down or continue to go down one route of hiking for longer. And then things start to calm down. And you see that in the markets and how they react as well. And then if we look at the previous market reaction that we had seen back on June 13th, now this is very important, and we'll look at the deviations. And when I was testing it and looking at how the data reacted, when the data is mixed, i.e., if you have one bit of data that is lower than the forecast and the other bit of data is higher, or one of them is higher than forecast, the market reaction is mixed and makes it difficult to determine which direction to go in on the first candle when that appears. It is like you have a bee sting and then you have a wasp sting when data is mixed, particularly for CPI data, which everyone is still focused on. So you have a lot more volatility that jumps in, that jumps in at that point. Usually, and I'll show you the reaction now, and then I'll carry on, so you can kind of get an idea of what I mean. Okay. Okay. So, this is about less than 10 seconds from the prior release. So one things that we all that we'll see is that when the data does come out, you can see that CPI was lower. The CPI year on year was lower than expected. Month on month was lower than expected. Month on month was lower than expected. But then you had the one sticking point, which is the core data. Again, the year on year that was higher than expected. So this initial market reaction was was very nippy. It wasn't a clean. There wasn't a clean initial reaction, and the reason why there wasn't a clean initial reaction is because the markets. What it shows you there is that the markets are not clear of what the Fed might do. Okay. Do they decide to go down, the path of continuing rate hikes, or do they, decide to pause instead? So that's what the market's thinking there, was thinking there at the when the CPI data had come out. A mixed bag of data makes it more difficult to define the market reaction. Whereas if you get data going all in one direction, okay, then you get a cleaner market reaction. So let me just skip ahead a bit more. You can kind of see what I mean. Here we go. So yeah, the dollar yen was not having a good day. The S&P, again, there was more of a mixed. It was more of a mixed reaction initially. You can see here on gold, on the initial move that we had seen, that there was a big old wick down and then it climbed back up. So again, mixed data is more difficult to kind of determine which way the market might go, and then you're kind of left to your own devices. Then it just becomes like the blind leading the blind sort of thing. Again, if you're unsure what the Federal Reserve is going to do, then the markets are also going to be unsure about which direction to go until they kind of find their way, which direction that they want to go. Right, so let's go to the deviations as well. So this is what I wanted to show you. So when data is mixed, you can see that so this is the deviations as well. So deviations, what is it? So this shows you how the markets react to the economic release or releases that have come out at that time. The initial figure here, let me use an easier one. So this figure here, this initial figure represents the move on the 1 minute candle on the first candle going to the wick of the candle, okay, to try and capture the entire move, okay, and the figure in the brackets represents the move 10 minutes after the release going to the end of the candle. Now, if you see a thing here where it says 52 ticks down and 48 up, that means on the same candle, the initial move was 52 ticks down, and then the candle ended. Then the candle to the wick was 48 ticks up. And then here in the brackets again, if you don't see, so basically if you don't see a word in here that says up or down, it's basically moved in the same direction where the first reaction had ended off, if that makes sense. Hopefully that makes sense. So you can see here, it was choppy for all, not just for the stocks, but also for the currencies, for the bonds as well, and also for gold. So mixed data, a bit more difficult to try and capture the initial direction. But when you do get data where let's say you have most of the data is all in line with expectation, but one bit of data is higher than the forecast or lower than the forecast, you get a cleaner reaction. Sometimes in the past, where you've seen it here, again, it depends on what the sentiment is at that time, sentiment is, again, that you might not get a clean reaction. So back on March 14th, where, 149 ticks down and 49 up and then 34 down, there was a mess back then. So that's another thing to be aware of, that it could also be a mess if you don't get all the data going in one direction. Okay, again, you kind of, it's not the blind leading the blind completely, but it does become a bit messier. So again, as said, so you more or less want scenarios where data is going in one direction rather than choppy. So here we've seen in the past where data was, all the figures were lower than expected, and they'd seen a cleaner reaction from across the market. And similarly here, if we're talking about recently this year as well, again, better reaction here when data, well, you might have had the majority of data that is, let's say, lower than expected or higher than expected, then you get a cleaner reaction. But a mix of ups and downs in the CPI print compared to the forecast, then you get this. You get this travesty. All right. So again, this deviation sheet, it's completely free to look at. So I will share a link actually for you to sign up to the MACROACE mailing list. Okay, let me get that here. So the MACROACE mailing list. So I put out an email every Monday for traders to have a look at get prepared for the week ahead. I'm trying to pin that, but I just pressed the 100 button instead in the chat. So there we go, much better. Got this sorted. So what was I saying? So the MACROACE week ahead, basically what I do is I give you the deviations for the week ahead for those releases that are upcoming, the live streams for the links as well, and also the summary of the week ahead. So for Asia, Europe, and US, and those are short paragraphs. They're not big old paragraphs at all. It's because this is where I provide the information right in these live streams here for you guys to take in. So that is, so I did provide the link there. That is also pinned. So I'm going to let's move that out of the way. So we've got about 3 minutes left. Let me get my TICKSTRIKE set up as well. I've also got my unusual activity set up to look at all the futures to see if there's any unusual trading activity, i.e., has the market moved compared to what it normally does? Okay, looking at the 99th percentile for futures altogether. What we'll also do is we'll also get crypto up as well. So let's see. So usually, okay, I'll go over it again. Looking at a 0.1% deviation on either side for the forecast data. Ideally, you want all the data pointing in one direction, either way, up or down. Okay, higher or lower than the forecast to be able to get a stronger, cleaner reaction. If the data's mixed, then good luck. Then it becomes a bit harder to kind of define which way the market's going to go. Okay, so we have 1 minute to go. Hopefully everyone kind of got that. Okay, let's see what happens. Okay. Da-da. 10 seconds. Okay, 3% lower than forecast of 3.1%. CPI month on month, spot 2%, lower than the forecast of 0.3%. Core CPI year on year, 4.8%, 4.8%, lower than the forecast of 5%. And core CPI month on month, spot 2%, lower than the forecast of 0.3%. Oh, there we go. Okay, enjoy the little ride. There we go. So data worse than expected, all went in one direction. Okay. So let's see how the markets are doing. So S&P going up, dollar yen going down, gold going up, Bitcoin also going up as well. So again, yeah, that's a nice release there. Okay, so the yen extending its gains. Okay, let's see what else we got here. Okay. Let's see what TICKSTRIKE gives us here. So let's do an initial. Patiliano said gold. No. Patiliano said earlier gold to predict would go sideways or up. Trendout said gold down. Patiliano says, I love being right, although my core prediction was a bit too high. That's okay. That's fine. Okay, this is I'm wondering, I do need to do a measurement though. I'm wondering if it'll be as strong as it was in the past. Whether or not the past reactions have come back. The big mega moves. Okay, that's 74. Ticks towards the upside on the S&P. Okay. Okay, dollar yen. See what you're doing. $63.5. Okay, markets are enjoying this. Okay, gold. Sheesh, dollar's been hit again. Dollar's getting pounded. Okay, that's... Let's see. Bitcoin. Right, son. Okay. So Bitcoin futures, about 40 ticks there towards the upside. Actually, if we're going from where it jumped, so probably about 44 to 40 ticks. Okay. US short-term interest rate futures rise after inflation data as traders pair expectations for Fed rate hikes after July. Okay. Basically, everything is having a good day for now. Okay. Fed swaps price in lower odds of a second rate hike this year. All right. Okay, there is a bit of a pullback. So, a little bit. Well, Bitcoin definitely is. Stocks. Okay. So, okay. Dixie is a bit reversing a little bit. See, so this is the indicator for how much buying or selling momentum, or how strong the buying or selling momentum is within the markets. And that's just, it's not just for currencies, but that's also for stocks, futures, ETFs and ETNs, crypto as well. Actually, let me bring up the crypto stuff. Let me bring up Bitcoin. Bring it up. Right, there we go. Okay, okay. Let's see what it does. Okay. So again, yeah. So again, something for so what we've seen here again, as said. So let me go over TICKSTRIKE again. It shows you how strong the buying or selling momentum is, and the way it does that using order flow data. This little box that we have here, the little ticker box, this shows you. So if there has a number and a minus and a plus figure. So a minus figure shows you the selling side, and vice versa, the plus symbol shows you the buying. Then on the flip side, what you have with this here is that if then to also understand number one, the figure number one here shows you that is the most sensitive to market reactions. So when there's a little bit of buying or selling that goes on within the market, then TICKSTRIKE will pop off here for you. So, but when you increase that, when you increase it to all the way to 15 is at least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs does TICKSTRIKE give you an alert. So of course, if you're day trading, scalping the markets, again, it's a useful tool to add to your arsenal to be able to jump on with and use TICKSTRIKE. So again, showing you how strong the buying or selling momentum is within any market that you're looking at. Basically, as I said, stocks, forex, futures, crypto, ETFs and ETNs, and your internals. Okay, so again, a very important bit of quite good bit of kit to just be aware of there. So that's TICKSTRIKE there. What we'll also do is there is also a 7-day free trial of TICKSTRIKE, which I'll put in the chat here for you. Okay, but just a quick question: did you guys find this useful? This information useful? Give me a thumbs up or a yes if you found it useful. If you didn't find it useful, say no, thumbs down. I want to kind of gauge whether or not what I'm doing here works. If it doesn't work, slap me in the face. Please don't. I'm very sensitive. I have very smooth skin. Don't smack my skin. But yes, give me a thumbs up in the chat, or give me a thumbs down if it doesn't work. Again, what we need to do is I did have the idea to make a questionnaire or a survey, but you guys are here with me, and it's just kind of easier for you just to put a little thumbs up or down in the chat. But yeah, so let me know how if the information was useful, or if it was great, terrible, so terrible, or if the information was so great. I can't wait for August. I think it's late August is when the presidential debates, not the presidential debate, when the candidate debates start in the US. I can't wait. It's going to be so great. I'm going to be, that was a bad impression. I apologize. But okay, markets are still lapping this up. Compared to last time around, it was a nightmare trying to look at, trying to trade with this thing. You just kind of stay out of it. Okay, so that's TICKSTRIKE there. FinancialJuice. Let's talk about FinancialJuice, the live voice and text service. So if you're not familiar with what FinancialJuice is, if you are, then educate other people. Let them know. But I will also do it here too with you guys. So FinancialJuice, what it does is it's a live voice and text service. Okay, a live voice and text service that gives you heads up to what's going on within the markets news-wise. If maybe there is, let's say, part of the market that's moving, but there isn't a news to to define why the market's moving in that way, but then that's our job to find out why as a news analyst. Again, so FinancialJuice is a live voice and text service. It's you have a live voice and text service is usually used by the big boys. Okay, your hedge fund managers, your big traders. Okay, they have access to that. Why do they have access to it? And why do they have it in the first place? It's so they can manage their risk. Okay, when they're trading, and they can capitalize on potential trades as well from a bit of news that might come out. Let's say after this CPI print at the next FOMC, or maybe through the comments that come through from the Fed members, their reaction to the CPI report is, nah, it's not enough. We got to keep hiking. That might be a surprise to the markets. And you might be thinking, if you didn't see that news, if you didn't have access to that news, you might be thinking, what just happened to the markets if there were to be a reaction? Well, you will know, because it's all in one site here on FinancialJuice. So let me close TickStrike so you can get a clear idea. So here you have your live voice here. You have your news feed here with the text headlines that come through. Okay. And on the left-hand side, you have your economic calendar as well. Everything is all in one place for you to use our news feed for. So it is... Kunta Armstrong said, hi, is there a possibility to get access to the Google Sheet? That's something that I'm working on. I think there might be an issue with, the problem is I think it might share other people's emails because you can see who's seeing it at the same time. So that's something I've got to work out. Maybe I just have to do it as a PDF like I've done before with the mail, the emails that I've put out on the Mondays. Remember, that's once a week, by the way, an email. Maybe just do that instead, rather than having I want to get like a live updating one for you guys, but I need to make sure that I don't have your information that's just put out there for everyone else, and some weirdo creep that says, "Hey, I see who's MACROACE too," or then it starts harassing you. That's not fun. Okay. So yeah, FinancialJuice, a live real-time voice and text service. If you want to sign up to FinancialJuice, then you can go here to FinancialJuice, to the link there. That again, if you want to go there, so there is a pro version and the light version. The light version of FinancialJuice, what it does is it allows you to a live version of FinancialJuice has adverts that play, has advert banners, and there is a delay to the site. But it is still useful. So if you've never come across a live voice and text service before, if this is your first time, then definitely go ahead, practice with it, have a little play with it, see what you feel. If you feel like it's something for you. If it's not, then again, it's whatever works for you. But if you do want to sign up to the pro version, make sure you have an account on FinancialJuice anyways first, okay? And then there's a button that says, you can click that says Go Pro here. Once you've clicked that button, it takes you to make sure, actually before that, make sure you've, verified your account in your email for your FinancialJuice account. Then you go ahead and select which subscription that you want. Once you've paid for your subscription, go back to the site, log out, log back in. Okay, that will act as a verification. Say that you're now pro, and you get to see this lovely website that we have here. Then just make sure that you have your sound and notifications on, and that there isn't any VPNs running in the background. If there are any VPNs running in the background, that can cause issues with the website. If the site isn't working for you, try incognito. There might be something they might have hidden in the background, like an ad blocker that might be getting in the way, if that's also causing issues too. All right. So and then finally, unusual activity. Let me bring that here. So what we're looking at here is we've got so again, unusual activity So if you like trading high probability stocks, futures, forex, and crypto breakouts in real time, then you can do that here in the link that I'll provide to you. So again, unusual activity representing moves in the markets when moving when you see unusual volume activity in a stock, let's say that is moving more than it usually does in the 99th percentile. Okay, so again, when there is an unusual amount of movement that occurs, then unusual activity will show that here for you in, or again, the simplest way. So you can see here, we're looking at the currencies here, all the currencies, all the futures as well. But again, you can look at, as I said, crypto, and as I said, stocks, futures, and forex, and you can look at those individually too. Let me just bring it up. Yeah, so you can do that here. So, there are all the currencies again. There you go. So let's say I bring up the New Zealand dollar is having a bit of extra moves. We're seeing some unusual activity that it normally does. Okay, let's see what's going on. Okay, how you doing, ZD? What's going on? So again, it's showing you, let's say, as I said, good luck trading that. Yeah, so TICKSTRIKE shows you order flow within the markets. It shows you the strength of the buying and selling momentum. Unusual activity shows you when a stock is moving more than it normally does, okay, in the 99th percentile. So let's say you usually move at a pace of 50 miles an hour, and then one day you go above your average speed and you go, let's go 70 miles an hour, or if you're from America, let's say you go at 50 kilometers an hour as your average speed every day, but then the next day you go 70 kilometers an hour. That's unusual. So that, again, that's a simple way to, actually that's a good way to explain unusual activity. Same thing here. That's what it represents. Unusual activity or movements within stocks, futures, forex, and crypto. Hopefully that kind of explains it for you, Arafat. There. Okay, that is the live stream there. We have the Bank of Canada. Let me get that live link for you, and I'll join you guys for that there. And then you guys can join me for the Bank of Canada rate decision. Also, as said, like I said earlier, don't forget to subscribe to the channel, share the video, get the word out there if you found the information useful. And yeah. Right, I'm scrolling up the video here for you. Bear with me. Let's see. Okay. Back at it again. Okay. Right, the Bank of Canada, 9:30 a.m. Eastern time. So in about 50 minutes or so, at 9:30 a.m. Eastern time, you can join me for the Bank of Canada ready decision. All right, I'll see you guys later. Thank you very much. Take care and bye.